Hello and a very warm welcome to everyone. I am Shuja Agrawal. It's my sheer pleasure and privilege to welcome you all for this inaugural panel at the 9th Indian Alternative Investment Summit 2022. Before we deep dive with this August panel, let's do some context setting on the same. Back in the 1950s and 1960s, modern portfolio theory served as a breakthrough in the realm of personal investing by suggesting that you can design an ideal portfolio that could render the maximum returns and take on an optimal degree of risk, the benefits and mechanics of diversification were established. It also established risk as a function of a portfolio, bringing traction to the idea that you can reduce your exposure by having a wide range of investments. Keeping that in mind worldwide, alternative investments are slowly moving from the periphery of the global investment landscape to mainstream investing. Driven by conditions like the need to increase diversification, maturing emerging markets, lower interest rates, and a structural change in capital formation, AIFs have grown at a rapid pace. There's some data here. As of 2020, alternative investments represented about $13 trillion of the global market, comprising private equity, hedge funds, real estate, and more. By 2025, experts expect it to grow to just shy of 25% of the global market. The latest data from SEBI suggests that assets of AIFs have grown about 30% year on year to around 5.3 lakh crore in 2021, compared to about 4 lakh crore as of 2020. What has driven this rapid growth is a fundamental question. Now, institutional investors such as endowments and pension funds are seeking more diversification opportunities. And while this growth ought to be applauded, yet a solid chunk of investors are not familiar with alternative investment funds, and therefore this may not be effectively utilized as part of a well-diversified portfolio. India's AIF industry in this space is seemingly underdeveloped compared to the rest of the world. When I talk about AUM, obviously the assets under management for alternative investments is about $54 billion as of 2020, and that's less than 4% of a public market capitalization. Is this because the minimum investment size is too high for Indian investors? Do traditional asset classes seem too attractive to make the change? Will the trajectory of our alternative investment industry emulate global trends and soak up a larger share of India's investing class? What is the future of alternative investments this decade, and what is the potential to grow in the face of several stimuli, such as the COVID-19 pandemic? To break it all down, please help me welcome Andrew Holland, Ashish Keher, Kalpen Parekh, and Vineet Rai. It would be a good idea to begin this with a more open-ended question. The question for you, gentlemen, really is that AIFs have been deemed to be low on macro risk, and so how much have Indians embraced this? And how do you think they've delivered commensurate to the low risk? Kalpen, want to take a stab at this?
Sure. Okay, thanks, Srija, for inviting me. And I have very esteemed colleagues, some friends, some seniors. So slightly nervous to talk. And this is the first time I've been invited on an AIF panel. Mostly I'm invited on mutual fund panels. So I'm wondering what has changed in my profile. So let me respond to this. At its very core, when I look at investing, investing is about, buying an asset class and taking advantage of the price movement of that asset class. To me, I don't look at opportunities from a wrapper point of view. And I want this to be clarified because I see this even after, we at DST have been running AIF for the last 7 years now. A lot of people misunderstand that AIF is a different animal. AIF is a vehicle. So today, if I want to move from place A to place B, there are 10 different vehicles in which I can go, depending on my preference, my ability, my understanding. AIF is nothing but a vehicle, and because it is meant for 1 crore and above ticket size, by default, the sophisticated investor, or we assume to be sophisticated investor, tend to understand or evaluate it. To give you an example, we run a couple of AIFs where we buy just stocks, like we buy it in our mutual funds also. The outcomes are the same because we are end of the day buying stocks. So if stocks in a mutual fund go up, and if stocks in the same AIF also go up, the outcome will still be the same. So a large chunk of money in the AIF industry is also a replica of what is being done in the fund industry at large. Then the next dimension is where AIFs have been able to differentiate and innovate. And that is something which I think, we as an industry need to focus a lot more on, to differentiate between, AIFs which are just wrappers on a mutual fund type of a product, which is long only investing, versus AIFs which are genuinely differentiated, which give different risk and reward profile, which give different path and journey, even to probably achieve the same return. And here, the first set of innovation was the hedge fund concept. Um, the concept of hedge fund, which has been very large globally, got introduced in India, I think 7 to 10 years back, which said that you earn more or less similar returns like market, but with a different path, lower volatility by going short on stocks. So I think to me, the journey of AIF, and we are still in very early days, because the understanding of the concept is still very low. Uh, the clarity of what is truly a differentiated product. Uh, so what I want to say is that all AIFs are not necessarily different. All AIFs are not necessarily unique, but few are. And investors, advisors, or partners in the ecosystem who are analyzing the space of AIF, the growth rates and stuff like that, should understand what are those USPs which are different. And one that I can immediately think of, which is very relevant to India, even for the next decade, apart from the last decade of growth, is AIFs which can deliver absolute returns. India is one of the most volatile markets in terms of its standard deviation, 154% versus 110% for developed markets. So where volatility is very large, we have more companies that make money. We have more companies that lose money and few companies that make money. And that is the core essence of, where AIF differentiation can happen, where we can make money through companies which don't make money by going short. Of course, there are risks and other parameters. But I think that is one truly differentiated, innovation which has happened from the AIF industry. That apart, a lot of AIFs, and I'll be very clear here, are more expensive, equity funds or more risky debt funds. And of course, then there are other platforms like, startups coming in an AIF vehicle, or private equity sort of vehicles coming through. But be clear of the differentiation. Ask these questions to me or to any one of us who are presenting an AIF to you. So I think that is my first starting.
Okay, so thanks for that, Kalpen. So Kalpen has very categorically laid out that for me, it's not about the wrapper. And I think for him, and he's been a long-term investor and a long-term practitioner in the mutual fund industry. And the sense I get from Kalpen very clearly is that the innovation level in perhaps AIF cannot be seen with the same lens. According to him, there are some genuine products out there which have innovated, but for the most part, he feels that just long-term equity funds packaged differently. Ashish, want to respond to that? You have somebody from the financial services industry taking a stab at the AIF space, and perhaps not so positively here, saying that maybe more innovation is required.
You're making a slide right away. Make the conversation.
No, perhaps.
But not a stand.
No, perhaps it's a fair remark. I mean, he feels that it's a remark from his perspective that perhaps more innovation is required, and it could be more marketing driven and wrapping, more wrapping, he said, where a lot of long equity funds are perhaps being packaged as AIF funds. Ashish, what would your response to really this be?
I think I completely agree with what he's saying on the fundamental premise. And I also got exposed to this couple of years back. I was looking at a presentation internally, and somebody showed me, look how AIF industry is growing. And at that point in time, it was even more audacious because they had added PMS into that category. And my point was that you have to look at the risk which the investor is taking and not the wrapper. Because if in that manner, you don't categorize mutual funds as a wrapper. There was a point in time when, when you met investors and they used to say mutual funds are not interesting. I think that long journey has been traversed where the regulator has played a role. I think AMFI has played a role and the fund houses have played a role to differentiate between underlying asset classes and the benefit which the wrapper brings. So AIF started with an objective of giving access to alternative investments when it was real estate, private equity, and then hedge funds. But somewhere down the line, there was some amount of wrapper business which also started. So if we take that part out, and there is a lot of regulatory intervention required. Yeah. In mutual funds, you have 10 categories, 9 categories, right? The regulator has defined the categories to the T. And then there are benchmarks around those categories. You look at the categories in AIFs, there is a single benchmark for Cat 1, there is a single benchmark for Cat 2, and there is a single benchmark for Cat 3. That itself shows you how rudimentary we are at this stage. I mean, in Cat 1, Cat 2, Cat 3, there could be underlying funds which could be targeting different asset classes, different degrees of risk, and the outcome for investors can be completely different. We as manufacturers or as wealth managers struggle to actually explain to the client that please do not look at the category benchmark, but look at the real benchmark which this category represents or this fund represents. I think regulatory intervention and work from the manufacturers themselves, but it has to be led by the regulator. They have to essentially define categories which will lead the path to what Kalpen was pointing out. So if you take out the wrapper part, let's say, I mean, now give or take, the AIF total industry size would be 5.35 to 6 lakh crores. I think more than 50-60% of that would be wrappers.
Okay, and Andrew, thanks Ashish. So I understand Ashish and Kalpen seem to be in the same camp, that perhaps a lot of wrapperization, if I miscoin the word, is really happening in this industry, and a lot of mutual fund like being products are being construed as AIF, and regulatory intervention is required. Andrew, what would your response to really be here to your colleagues Kalpen and Ashish in the financial services space? They seems to be really holding the ground on the more mutual fund side of things here in terms of a larger retail participation, and they are saying that perhaps some products are just being being packaged differently. That's really what is in the AIF case. Yeah, Andrew, I'll get to Vineet on this one. I think we started a very, very interesting premise here, really, this discussion. Yes, Andrew.
So I think I should take Kalpen around and meet all my clients, because this is
I would love to and get some money from
set it up very nicely, because listen, it's everything they've said is correct. I mean, when we meet our investors, first of all is the education on what is an absolute return fund, what are you trying to do, and how does that compare? So what you have to highlight is what are you trying to compete against, right? So in our absolute return fund, it's very obvious. We're competing with a debt type product, a liquid type fund, a small duration bond fund, because the risks are the same in terms of what the risks that we're taking, in terms of the volatility of risk. Right? In bond funds, it's 3 to 5%. We're exactly the same. So the risk is there. Then is what are the drawdowns that you could get? How much money can you lose? Right? That's the other thing that the investor needs to know. And ultimately, how much are they going to make? At the end of the day, they need to know, if I'm getting 3-4% from a liquid fund and similar risk to investing in your absolute return fund, how much more can I get from doing that? And I think that's the key, because a lot of investors come in and say, we're looking for products, we want to invest in the equity markets, but we don't want to take some of this volatility. Therefore, you can look at other types of funds within the alternate AIS, where you're investing some in as a long only, and then using your long short to try and protect or enhance those returns going forward. So all of these things can be played out, but Kalpen and Ashish are right in terms of that. These are differentiated products. They're not equity products. And then that's the difference. It might be in the equity markets, but you're doing certain things on the risk side of it to either protect or enhance those returns.
Okay, Vineet, I wonder what really is your viewpoint on this. You've heard all your three colleagues on this entire wrapperization phenomenon happening for the AIFs. And so what really is your sense that you get? I mean, you have been somebody who has really been there in the venture industry for a while now. And so what are you gathering from what your colleagues in the financial services space are speaking? Of course, they handle a larger funds portfolio, and perhaps a lot of mobilization of retail investment is happening, and they're coming from that perspective. What is your sense?
Yeah, so first, I had never heard the word wrapper, so I'm educated, but I come from a different side. I'm an alternative fund manager. And within the alternative investment category, I think I'm also coming from the other side, which is essentially category 1, category 2 kind of investors. So and I'm actually a more specialized one within that, because we are the impact side, which is even is fairly new within the thought process of the regulator as well. So I mean, generally, if you look at it, the participation, the way alternative investment funds have been, it's actually a blind pool. So really, the most distinct reason of an alternative investment pool is when you are putting in money, you do have no idea where that money will be deployed. So you at best know, and you have to actually totally depend on the fund manager's strategy, which comes through the PPM, and there's a significant amount of disclosures. But since it's a blind pool, you have to actually then trust the manager and their track record to actually participate. And I'm actually going to focus on AIF 1 and 2, because that's where most of our funds are registered as AIF 2. Earlier, before this, and most of our money were institutional money, so we were not really raising significant amount of retail money. It has been, I think the first time I actually went to Indian retail market or the wealth investors only in 2017. But with the significant change that has taken place in the way Indian funds, led by the SIDBI's fund of fund, the government of India has launched. Now you have the SRI fund that SBI Caps is managing. There is another United UK and SBI partnership fund which has come in. So there is, and then you have LICs of the world and insurance companies also participating with very small amounts of capital. The general retail participation in the funds is still very, very small, especially those who are actually coming with venture capital, private equity, and in the unlisted category. A lot of the discussion that you heard about a wrapper side is basically when you are going on the listed category. But there is a very large, thriving, and a very exciting part of AIF. And this is actually acknowledged by the Prime Minister this time also. All of us met the Prime Minister just before the budget. There was a clear acknowledgement by the Finance Minister in the budget speech that part of the world, that part of the AIF is very crucial for the country's future, partly because this is actually relevant for job creation, which is very important for the world. And because we are creating new companies, and these companies are the ones that are going to be the growth engine of the future. And so from that perspective, I actually see the real work is being done. There is no referring, at least in the category 1 and 2. Of course, there are some people who are actually looking at mutual funds and alternate vehicles for mutual funds. But that's, I think, is actually a very different kind of a market, not the one that I represent.
Okay, thanks for that. Talpin, I would like to sort of come to you and take this point of wrappering that sort of you mentioned. I sort of tend to agree with Vineet here on this unlisted category. So when you have a blind pool of capital, I mean, historically, if you look at private equity venture capital, what really is it? It's the money of people like you and me, right? Which gets recycled into an endowment fund or a pension fund, and they invest into a VC or a PE fund from an LP perspective, right? And that investment is a locked-in capital that goes and stays into the country for 5 to 7 years at least for the life of the fund, and that results into entrepreneurship, job creation, and one can always argue what the track record of private equity has been improving for the last couple of years, but that's really the thought process has been. Perhaps your comment on wrappering is relevant for some aspects of AIF where they tend to compete with the mutual fund industry. But even on that, my question to you really is that the very fact that AIFs have nudged a 5 trillion mark, it shows that perhaps there seems to be some fatigue building out in the mutual fund industry, and perhaps the HNIs did want a different kind of asset class to park their money in. So you can't take away that either, right?
So Shrija, I won't say I'll clarify, but I'll just stress more on extending what I said, that a reasonably large chunk, especially in the Cat C vehicles, is very similar to what is available in a liquid mutual fund format. But that apart, like what Vineet mentioned, and I also said what Andrew mentioned, that there are products which are run like a hedge fund with very different mandates, with very different styles. Which is the second part of the AIF category, and here is where there is need to illuminate our audiences of what is truly alternate. Not all AIFs invest in an alternate way of investing. Is something that needs to be further done. The second point is that what are the advantages of such locked-in capital in terms of the ecosystem? So there are two advantages we need to draw from any capital allocation. One is the owner of that capital should make money. Ultimately, that is the final objective. So whether it is your and my money getting routed through a pension funds, finally we need to make money. And the second thing is, what is it helping the overall ecosystem? So clearly, locked-in capital has huge merit, because we all know that the biggest dimension in compounding and capturing market cycles, asset class cycles, theme cycles is time horizon. And here is where products with long-term locks, like 7 years or 10 years, do allow investors to remain patient on one side and to take advantage of the underlying asset class. So, and more so in the last 4 or 5 years, what we've seen, and I think, I would want to see how does this really play out when the global interest rate cycle reverses. One observation or one thesis I have, and this is a very loose thesis, is that there's a lot of easy money floating around the world, which has come in across startups through various vehicles, including AIS, at very, crazy sort of prices. And, only time will tell how this really plays out. If we see the picture that's playing out in US right now, where, underlying companies which are startup-like at price to sales of 20, 30, 40 times, getting disrupted. In the last 6 months only, we've seen this movie. Will it repeat here in India? Only time will tell. So right now, we are in a cycle where there is abundance of capital. And generally, my experience has been that when capital is abundant, returns are scarce, and vice versa. So we'll have to really see how this seasons over full cycles when capital starts becoming scarce, and that's when actually returns will flourish. And how many investors are able to live through both the cycles? So lock-in structures hopefully will allow investors to experience both cycles and eventually come out of this with meaningful better returns, because when I'm giving up my liquidity, I need to get compensated for something. Ultimately, it should be returns, or for same return, am I getting lower volatility? So I think only time will tell how the outcome comes. And like I think in everything, including in our own business. So when I currently in my role don't run just a mutual fund, we also have AIFs. We also have wrappers. So I'm not saying we've not done wrappers. We've also done wrappers. We also run a hedge fund. But net, we are still in the first leg. 5 lakh crores is very respectable size. This can actually be 20, 25 lakh crores as time progresses, because it is straight away catering to the cream of the country. AIFs are straight away catering to large investors, wealthy investors, family offices, institutions. So converting their capital into more efficient capital is not difficult, unlike in retail where you have to reach crores of investors. So I think the journey will be fairly I would say faster in the next 5 to 10 years as more investors learn and as more choices come, and regulators will have to allow for more innovation in different pockets.
Thanks for that, Kalpe. And I think I tend to agree with you that, of course, there is a lot of easy money available because of the benign liquidity environment. We have seen unicorn obsession playing out, both on the side of these startups and the investors. Vineet is here smiling and copiously taking down notes. Vineet has a point.
I have actually a point. So there are 3 things that we need to understand. First and foremost, out of the 6 lakh crore, only 60,000 crore in category 3. And the hedge funds and others would actually lie in that. So it's actually just 10% of the market. Almost 10% is in category 1, which is purely venture capital. But in India, venture capital is category 1 is not being used by everyone other than those who actually really want to do early stage venture capital. For example, Avishkar itself doesn't do category 1. We register in category 2 because category 2 allow you one single benefit, which is not available to category 1. We can invest in a non-banking finance company as well. And that's why if you look at India's differentiation, 80% of AIF is in category 2. So that's actually the first thing. Once you are in a category 2, whether you're a debt or an equity fund, if you are an equity fund, the longest life is 8 years from the final close, normally 18 months, 9.5 years, plus 1 plus 1, 2 years extension. So you're talking about an 11.5 year of lock-in. Now, when you are talking about a fund of that size, what happens, what kind of capital comes in? Generally, when let's say we raise $100 million, the call of the capital, this is a commitment, the call on the capital is roughly 20%, 30%, 20, 30. And that's by the 5th year, you call in 80 to 90% of your capital. And then you start returning it from the 6th year till the 10th year. Now that's really the cycle. When it comes to valuation and startup valuations, let's actually also understand there is a very clear distinction on what you are doing. So let's say if you're investing in a micro, small, medium enterprise, then you are actually looking at profits, bottom lines, and value. But when you are investing in a tech company, and I'm being very specific, when you are actually looking at a tech company, the investing is for dominance. It is not for value. Valuation does not come in from the bottom line. It has no value in that. The valuation comes from dominance, and dominance will lead to the bottom lines and very large shares. So there, the investment is not being done because you are actually going to create certain amount of cash flow and returns. It is being generated because you want to create a dominant position. And the reason you see unicorns happening in India right now is because for 8-9 years, you've actually been talking about the dominance and size and scale of Indian market, but the penetration of internet, the wide use of internet, etc., and the comfort of the market. And I think the challenge that future retail is facing, is actually a clear indication that India is moving away from the very physical format of businesses to a very virtual format of business. And that is where the tech dominance investing, which actually creates these unicorns, is coming through. So it's a game that a lot of people are not able to understand. And therefore, people find it very amusing that you have no returns. I mean, almost everybody who's actually listed, so-called listed companies, have no bottom. And so if it is bottomless, how come the valuations are so high? And I'm again repeating it, it's about dominance. It's not really.
Yeah. So I think Vineet, we get your point. That's a different subject matter conversation altogether, because the contours of public market investing and investing in private companies will always be different. Private companies have the luxury of raising capital from investors who are perhaps more sophisticated. It's a 5 to 7 year term horizon. You're looking at path to profitability, and the different kind of reasons such investors are guided by. There, perhaps the money will decide that who essentially is the leader. And a lot of money goes into those companies. We're seeing the likes of SoftBank and Sequoia Capital, and that's a different game that we're talking about, especially in the venture PE market. And talking about product innovation that Kalpin also pointed out, really in the AIF market, my fear really is that on the back of this obsession and perhaps overawedness that we are seeing for startups, it's great to be romanticizing them, but I'm seeing a venture fund perhaps mushrooming like startups themselves. Every day I have one or the other funds and some announcement or press release coming in our inbox that there are few founders who made some money and have launched an AIF. So my question really to you, Ashish, is how do you see this trend? Is it a healthy and a positive trend which deepens the market on one hand? Or second, do you think there's a fear of this also being commoditized somewhere?
So I would just like to, give a few points before I attempt to answer this question, which is, let's say, more AIF specific. The way I look at AIFs is, there are traditional ways of investing, and traditional ways of investing could be, bank fixed deposits, buying direct bonds, buying mutual funds, buying equity stocks. Most of them offer you an easy in and easy out. You don't need to wait, and it can absorb small quantums of capital, and the risk return dynamics are fairly well known to people because they've been in existence for a long period of time. So it's suitable for a large set of population, right? What, in my view, AIFs bring to the table is essentially where there is a need of capital. There is a need of capital either to invest and grow over long periods of time, but in general, public does not have the patience to wait, or the format of the vehicle in which today the investing is happening. Let's say you want to invest in real estate credit. I don't think mutual fund is the right format, because there is a daily NAV, there is an entry exit. You cannot execute it. Neither is the population which is exposed to mutual fund, because it is well distributed through tier 2, tier 3, IFAs, where the know-how or the ability to discern the risk is limited, which is why the vehicle is important. So do not get us wrong in that sense. And there is enough and more happening there too. But in my view, much more can happen in order to educate the investing community, even the so-called sophisticated investors, educate them on the risk reward of this vehicle, this part. And nobody see alternatives. Why is it called alternatives? It's not mainstream, right? It will always remain alternatives. It will be 10-15% of your portfolio which can stay locked in, and can deliver you superior returns if you are locked in, which doesn't happen in traditional classes. So the existence of it and growth of it will happen, and evolution happens because mutual funds also went through their evolution. There was no categorization 10 years back, there is categorization now. Similarly, AIFs will also go through. Having said that, on the startup thing, I mean, this is an interesting topic, and the way you're seeing, things, every asset class goes through a cycle of euphoria and trough. It's not that it is just because in the AIF space or startup space, and in every cycle, there are good companies, there are bad companies. Yes, if you're going through a lean phase, your probability of making money goes up because generally valuation expectations are low. Even if I take Vineet's point, right, that I do invest in technology for dominance, and he's bang on. But it depends on the general availability of capital and the market environment. The same company will be available at a lower valuation. So what you're seeing right now maybe is a part of the cycle. It cannot become commoditized. I mean, there will be many failures and it will go through its set and it will only get stronger. So you can't isolate and say that this is going through. The same thing happens in equity. The same thing happens in infra. 2003 to 2008, a set of companies performed. 2008 to 2013, a set of companies performed. There is a year of mid cap. There is a year of large cap. Everything goes through a cycle. And I think we are
this is the year of startups, essentially. 2021 can definitely go on the history, 44 unicorns, year of startups, and perhaps more and more retail investors. And you can talk at the Shark Tank phenomenon, or the fact that everyone from tier 2, 3 cities, there's so many unicorns coming. People are asking, is there a way I can invest in startups? What is the route for it? So many people have made money, and perhaps AIF, 1 crore investment threshold, can provide that route to you. Andrew, my question to you, and you've been listening to this entire conversation playing out really. So mutual fund also went through its own turf of highs and lows. Of course, that is a more hot money environment chasing in, also subject to the vagaries of a lot of hot money coming to India. So what is the incentive for someone like you at Avendus to have an AIF? If a lot of money is being utilized to mutual fund, and I have that question for Kalpen also, that what does your conversation look like from your number 2 or your colleague who's handling the AIF vertical? Is it like that the outsized attention is always given to the mutual fund industry, and AIF is just one way how you want to get the money of the HNI? Are there internal tiffs also being seen in the boardroom then? One is rooting for AIF, the other is rooting for mutual fund industry. I mean, how does that really play out? Give me some color. Andrew, first you, I'll get to Kalpen, and then I'll come to Vineet. Yes, Andrew.
Yeah, well, I wish our board meetings were that colourful, but anyway, they're not that colourful. But listen, it's very simple. I mean, just look at what what's happening globally. So you can say that alternates are 5-10% globally, right, of the assets under management, but there are 30 to 40% of the revenues of the industry, right? If you have a mutual fund, Kalpen will know you're sitting on 30 bips, maybe, I don't know, 40 bips. AIFs, 90 to 100.
Wow.
This is the way, the industry is going. Everyone's going to compete in terms of ETFs, and then that's a very low margin, very high turnover business. So alternatives is not going to go away. One of the disappointments, I think, for the Cat 3 industry is the taxation on derivative products, because it's 43%, and there's just even if you don't pay that tax, you get taxed at that rate. So there needs to be a pass through for investors for this industry to grow. And you know what? I think that's something that's needed, because we've talked about Gift City, which is obviously separate, but we're trying to put funds there which foreign investors will invest for our expertise in maybe doing long, short, or hedge funds. But if our industry is not big enough here and there's not enough people doing it, someone else is going to do it offshore, through Gift City, and it's not going to be local companies. And that's my only kind of reservation about the growth. If you give a level playing field, this will grow exponentially, because you do have the talent here, and it's a to my mind it's a revenue for the mutual funds, which I'm sure that, that they're looking at and will continue to increase their exposure to alternative type instruments going forward.
Thanks for that, Andrew. So Kalpin, I come to you. So the question that I asked, 3 questions for you. So what is your incentive of having an AIF offshoot at DSP Mutual Fund? You run a large, successful mutual fund business itself. Is it just another vehicle for you to tap the HNI money? Second, how does the conversation look like to you from the one who is managing the AIF piece for you? Is it always a slugfest? Number third, how the discussions like on the product innovation side? Do mutual funds allow for that innovation, which perhaps AIFs allow? Yes. And then I'll go up to Vineet. Yeah.
Your questions actually, make me think what I have to speak to my board next week, because they are asking. To me, the starting point of offering or even building the AI business was differentiation, and differentiation from what we own. So we've been there in business. So when we launched our AI business, we had 17 years of track record in the traditional mutual fund business. And the first launch of AIF was a long short fund, which was new to the industry, or rather new to DSP. There were a couple of them. I think Andrew had pioneered that along with Edelweiss, that concept. So what we did was just carry forward there to say that this is a new skill set. So we hired someone who came from outside, an Indian who was working in UK. He came back and he said, I have the talent. If you're willing to give me the credibility of your platform and access to your large high net worth individuals and wealth management channels, let's put a product together. So we started off with a long short absolute return product. So it was complete product innovation. That was the first starting point, so that we are more relevant to our large family office investors, to our large wealth managers. Because when I go to Ashish, for example, who is today running a very large wealth management shop, he will say there are 40 mutual funds with similar products, including yours. But if I go to him and say that apart from that, I also have a new product which we didn't have before, it increases our odds of being more successful and taking a larger pie of the wallet of our Indian investor. The second important point for us was also catering to the global capital. So today, let me tell you that a larger chunk of our AIF money is from international investors, not Indian investors. So it allowed us to also diversify our investor base and hoist our flag in the international market. So today, when some of these larger pension funds out there, when they look for absolute return products in volatile markets like India, we are one of the few names that comes up. So it allows me to build those networks. The second question was how are the conversations internally? In fact, I would love if there is a slugfest between my alternate business head and the traditional business head. Unfortunately, we don't fight for more growth, but there is a very large opportunity. And I keep saying, when we go to many of our clients who say that we don't want to invest in your equity funds right now because valuations are very high, I would want my absolute return guys to say that don't give all the money to Andrew's funds, give some to us also, because we have the product ready. So I think the opportunity is large wherever products are unique, where they fulfill a certain outcome for our investors. I think the third question I missed, Shreya.
We spoke about the product innovation side. Yeah. What really are?
So the product innovation, I think there is room, by creating different levels of return and risk points and different asset classes. Our current limitation is more at our end in terms of the skill set we have on our platform. Our skill set is long only and long short. We still don't have skill set for evaluating, alternate businesses like what even Vineet mentioned. And even it is my limitation to understand that space, and we don't have that talent. So we are right now staying out of that. But with regulatory, mindset of sensible innovation being allowed, and if platforms like us can, fill the product gaps, I think we'll be able to offer meaningful products for our investors.
Okay, Vineet, I come to you and then I'll come on to Andrew also. In terms of what you're seeing in category 2 funds, for instance, private equity funds and VC funds coming, and like also mentioned, now you're also seeing a new trend of startup founders congregating and starting their own funds. What do you think about that trend? Do you think that competition is also building up in the seed stage / Series A space? And do you see it as a healthy trend, or do you see it as too much capital coming in that space?
Srijal, I started in 2001 with 5,000 rupees of personal capital. So in 2001, you could actually count on your fingers. There was first no AIF. There was only what you used to call a fairly VCF guidelines.
True.
You were there which actually had no real consistency in many issues. Basically, most of the funds that exist today or that have some track record are 2005 to 2010 vintage. Most of people actually did their closures between 2005-10. A lot of people between 2005 and 2007 did very bad investing because we were not experienced enough. We were trying to actually invest in family businesses, thinking that the families would want to give control. But unfortunately, we realized most families did not want to give control. So if you look at the track record of those people who came in between 2005 and 2008, most people actually burned their fingers, did not do very well. And in 2013, 14, 15, India was massively criticized for not really creating any value for investors, more so the dollar investors. Normal Indian investors were completely not interested in the VCF private equity industry. Now, this started changing only 2016. So if I actually make a map of my exits, which is the money that I have returned, or my DPI started moving up from 2016. What was the phenomena? It was actually this whole startup movement, government actually playing a role. There's a lot of excitement. And that excitement suddenly started making the world take note of India as an emerging powerhouse of creating companies that may create value. Now, this was not openly happening in pure technology space. It is happening across the board. So Avishkar is not really a tech investor, but we are actually seeing exits. And if you map anybody, any of my peer who are pure, so you took Excel, Sequoia, Chirate, any of them, actually tried to map all of us, you will see a significant movement up on our DPIs from 2016 onwards. Now, when that starts happening, suddenly people are excited. Till 2016, 17, you have to be really a brave guy to be in venture capital private equity industry. But post 2016, 17, two things are happening. One, we are returning capital. So there is a lot of capital flowing in from long-term investors who have actually seen return of capital. But then there are lots of founders who build companies have actually made a lot of money. And those founders now have actually understood, one, they have understood how to build a business. They also understood the game of term sheets, signing, valuation, value creation, and seen liquidity. And so what is happening is two things happening. One, there is a product diversification taking place, like you were hearing Kalpin talk about it. It's taking place in venture capital price. So you heard of venture debt. Venture debt as a product is fairly new in India, but it is actually taking shape. Trifecta has actually done well. Innoven has done well. So many other people have done well. It's a high risk product, but even there people have actually done well. The second part is, so therefore new founders are coming with different. The second thing is India now is no more a venture capital this thing. You have angel investors, so individual investing. Then you have angel clubs. Then you have angel funds. Then you have early stage venture capital, and that venture capital is also diversified into deep tech, normal tech, etc., etc. And then you have private equity, and then growth, late stage. Then you get into bulge bracket. The whole segmentation is actually very good, and it has happened because new people have come. Now we have not heard about it because you were not hearing these announcements coming in a crescendo. Of course, the massive liquidity that you have seen has played a role in a lot of people participating in it. But venture capital is a long game. It's not a 100-meter dash. It's a marathon, which is 10, 12, 15 years. And remember, you have to build an institution behind it, because 3 years is fine, 5 years, but even in marriage, people struggle in 10 years.
Okay.
So running an institution in 6, 7 years, so those challenges will be there.
Thanks for that, Puneet. So I think just to sort of recap all of this, one thing that is becoming very, very clear to me is that having a mutual fund type of lens, which is a traditional investing, which India has historically seen, and we did very well there. We had star fund managers. We have Kalpin here with us, and that gave rise to a lot of star fund managers. But perhaps you can't apply the same lens when you are growing in the AIF space. That requires a different skill set. And even that market, even if we say it's young and growing, there's huge competition. If I talk about the private equity and venture capital itself, large space, even that industry is going through a crisis of its own, because you have to differentiate yourself, because ultimately there's more capital and less opportunities. And then you're competing with the likes of global funds. That is number one. Then you have someone like Andrew Holland, who created a category of his own in category 3, innovation product. So there will be sectors created, but there will also be niches and sub-niches. There could be a tech fund, there could be a manufacturing fund, there could be ESG, there could be venture debt. So the deepening of financial services will be there, but the appeal to the product managers will be that you can't apply the same lens, saying that this worked in the large retail industry will work here. So Andrew, my question to you really is that what you did with your very successful product in category 3 at Avendis, what really are your thinking lines when you think of introducing a new AIF? How do you go about product innovation? Give me 2 or 3 areas which serve as your thinking line on introducing a category. And perhaps Kalpen is listening to you very carefully, because he said that he does not necessarily have the skill set. And when he started out, he told his investors that don't give all the money to Andrew, give some to us also. So yes, Andrew, what would your response to be on this one? Yes, thinking lines on product innovation for AIF. Yes.
It's actually, if you think about it, it's very simple. You have a risk curve, right? You have low volatility at this end and high volatility, which is usually equity. At the low end, it's debt. How can you go along that risk curve and introduce products which are innovative and give the investor similar types of returns that maybe you get from the markets, but with lower volatility or lower risk? And that's what you're trying to do. Now, there's only so many products you can do with a fundamental long short. So what we did was we hired a team of quants team, which have been doing quants in India for the last 11 years. And again, through that now we can think about different types of product, market neutral type product. Can we do smart beta type products? Which is starting to use your fundamental and your quants expertise. So all of these things that we're now looking at, because we've got a new set of skill sets that have joined in with us, and we can innovate and look at tweaking certain products or introducing new products like market neutral, which we will do, which will give you a higher return than our traditional flagship product, lesser return than our enhanced type product, but will get you nearer to your kind of nifty with an extra alpha on top of that. And again, it goes back to that, what's the risk of that? And I think all of those things, you need to explain to the investors. So that's how we go about it. And then also you've got to look at the scale of the product. It can't be just, if it just does, 300-400 crores, it's not really, you don't be able to build a big product from it. But it's not just onshore, and Kalpen mentioned it, it's what can you bring offshore? And hopefully through Gift City, that will be a vehicle or a place where we'll be able to attract foreign money into our funds.
Thanks for that. So Kalpen, did you get 5 ideas for product innovation for the AIF space? If you want, I can give you some ideas, which I think I would definitely want to see a fund which can actually mobilize capital made for Bharat. Why don't we have a fund which only backs tier 3, tier 4 entrepreneurs and can give an opportunity to retail investors to participate there? An ESG fund, which is mainstreamed ESG. Why don't we see funds or categories like that? A very great venture debt fund, because it gives you a beautiful combination of taking equity plus a debt size of risk. And a lot of startups are embracing that completely. So Kalpen, is something holding you back from innovating at DSP more on the AIF side? Or do you give outsized attention to mutual fund thinking, okay, that is my forte and I want to go deep into that? Yes.
I just respond and, taking leave from what Andrew mentioned, simplicity is very important of what we're trying to achieve. And I think there are mainly 2 levers in investing that one needs to control, either returns or risk. So whatever design allows me to balance these 2 is what we try to optimize. Now, on the other hand, some of the ideas that you highlighted have a thematic orientation to it. So, I read somewhere that being patriotic is not necessarily being profitable at times. So we may design a fund for Bharat, but ultimately, the same Bharati investor ka paisa bhi banna chahiye, who's investing in that fund. So we have to be mindful of that. But having said that, I tell you, there is merit in some of the ideas, like you mentioned about venture debt. Trifecta is a fund where we have ourselves put some capital from the AMC, just with the intent that we'll learn the ecosystem and see how we can think about it. A lot of young companies, after having built a solid business model in the private venture space are now coming for listing. So if we can learn those, we are thinking how can we be 1 or 2 years ahead and build a portfolio of such companies. So there are some of these pre-IPO funds which have come up, but they're understanding how many of them will succeed. Base rates are relatively very poor in that space. So few do very well, but most don't do very well. So how do we increase our odds? So our thinking right now is that we want to innovate, but we also want to not just innovate from a labeling point of view or a narrative point of view. On ESG, very dominant theme globally, right? For the last 5-7 years. Two schools of thoughts, and these are not necessarily my school of thought, but they are very controversial school of thought. One school of thought is that people who want to charge higher management fees for passive investing will attach a label to it. There are so many ESG funds globally also where some of the biggest governance accidents have happened. So the G got completely forgotten. In India, by the way, we in our simple mutual fund have a product which starts with only G first. That any red flag on governance, those stocks don't come in our portfolio, come what may be the returns. So these things can be executed in a very simple way. And to me, governance matters more than anything else.
So Kalpen killed all my ideas. He called
No.
Building for Bharat as patriotic, which will not necessarily translate to money. He said ESG is completely a narrative building fund. A lot of funds are there in that direction. But of course, he held the ground on venture debt and said that pre-IPO. Ashish, if I were to come to you in terms of how you are innovating at Edelweiss, give me 3 ideas which appeal to you very well in terms of what you are seeing from the market. What would those really be? We've already heard Andrew and Kalpen on this. What is Edelweiss's view on innovation in the AIF space? Yes.
I think if you look at Edelweiss as a whole, we've been at the forefront of innovation on the AIF side. So hedge fund was one of the first ideas. If you look at the yield space, right, we looked at the entire market and yield was driven by traditional products. And because those products, as I said, have a liquidity constraint, they have to be highly liquid. So they will not be able to deliver the return which client wants. So we created a whole spectrum of yield funds across infrastructure investing, distressed asset investing, performing companies investing, all in AIF format, 7 to 10 years, which delivered about 600, 700 basis points net yield above mutual funds to investors. And these are large funds. I mean, our last distressed fund, we've been able to raise 10,000 crores in a single fund. Then we went on the equity side. There were a lot of private equity funds which clients had access to, but they didn't have something what we called a crossover fund, which is a pre-IPO going into IPO. We started that idea in 2017-18. We did 2 series. We are actually completing now. One of them will deliver 3x and one of them will deliver 4x. And we've launched more series now. So that is what we are doing. And in next 6 months, we'll come to you to take your check for VDF. We've already registered the trust. I think it's in the making. The team is being hired and we should be hitting the market in 2 months' time. So on the AIF side, I think I would rate our innovation as one of the highest in the market. But having said that, there is still a lot of work to be done. So we looked at yield as one category. We looked at equity as one category and absolute return as one category. So on all those 3 fronts, we tried to bring, and obviously, I mean, necessity is a mother of invention. We couldn't, build a mutual fund like Kalpen at that point in time. So we had no choice but to innovate on the alternative side. And there is a large set of investors which will want to play on this between both global and Indian.
So you perhaps missed the bus on mutual fund side and you are catching up on the AIF, and Kalpen is building it from the other end. He's already established the mutual fund and building out the AIF. And so Andrew, you heard all your colleagues. If you were to give me one product innovation in the AIF space, which really sort of caught your attention and which really marveled you, and you told yourself, oh, perhaps I would have started this, what would that really be?
So unfortunately, I don't think there's, within Cat 3, I don't think there's that many type of products. I mean, if I look offshore, there's probably, a lot more different types of products. I think the way this industry will develop and what we're looking at is again, it's going to be through certain themes which could play out through sectors, or could be the whole kind of technology IT sector. There's going to be lots of as these companies grow, lots of opportunities to do something around that on a long short basis. I'm sure it's just that obviously it's still early days in the evolution. You still don't have that many kind of IT tech companies listed in India. I'm just giving you an example, and I think this really kind of, I think says where we are and where we will have to be, right? So if you take that Facebook or Metaverse market cap fell more than the largest company in India, it tells you everything. So there's still a long way to go in terms of the journey for India. And I think the more innovation that we keep doing along the way, as long as the education to the investors is about emphasizing on the risk and what their return should be, I think is the key, rather than just trying to find a new product just to suit the needs. I mean, I know there's lots of startups out there where you could now put your money in. If you say, listen, I just want to have infrastructure stocks, they'll give you a basket of them. Now, whether those fundamentals of those stocks have been looked at, I have no idea. It's all very good when markets are rising. Markets fall. I think you'll hear a lot more about the pain that these people will be taking, because they are just using technology to do investments, which maybe it shouldn't be there right at this moment.
That's a strong sort of word of caution coming in. I do hope that amongst the audiences that we have and people who are thinking of starting an AIF are sort of making notes of it. Okay, last round of questioning. We are sort of over time. Concluding remarks really on the future of AIF space. What would that really be by 2025? We would do some crystal ball gazing. How do you think this space would have really evolved 3 years from now? I'll start with you, Vineet, and then get on to quickly in like perhaps 2 or 3 quick sentences. Yes.
Crystal ball gazing is a risky idea, but I think AIF will continue to be 10-15%, as was rightly said earlier, not more than that. But because there is an overall allocation will keep moving, this would be a fairly large space in my view going forward. And I think innovations will take place both from those coming from the listed equity markets, but there will be a significant amount of new offering and innovation that will come from the unlisted side. And Avishkar itself, we do everything that you talked about, Bharat to tier 3, 4, etc., etc. But we are going to be launching our first carbon first fund, which in my view is going to be a fairly path-breaking innovation. Probably globally, not just in India, where we are actually effective and invested only for capturing carbon. To Kalpin, we have too many innovations, too little capital. You have all the capital, so we can probably have a partnership.
I'll call you after the session.
I'll call you after the session. Okay. Ashish, what about you? Concluding remarks on this one? Yes. Ashish, you're on mute.
Industry is nascent. Evolution will continue. I think regulatory intervention of better categorization so that people are more aware of what is an equity only fund, what is, so basically risk and return, the fund category should be able to relate to the investor. In my view, benchmarking will become more scientific, leveraging will be allowed. International investing today is very cumbersome for AIFs. That will come in. So it will become more and more investor friendly and easier to educate the investor, and also because of the differentiation, and as Vineet also said, the size itself will grow. I mean, 2017 the entire mutual fund industry was 17 lakh crores, equity fund industry was 6 lakh crores. AIF is today touching that. So from an absolute size perspective, India today, I don't see any issues. I mean, it will continue to grow, but as a percentage it will remain between 10 to 15% of the overall industry size. But it will become a more understood category, a more transparent category, and people will be able to relate to it more. And that's when the growth becomes mainstream.
Okay, Andrew, what about you?
So I'm not going to repeat what she said, because she just summed it up very well. But what if I had a vision for 2025, it would be this: is that we've continued to help grow the Cat 3 industry domestically. And if we could grow that and kind of align it with what we're trying to do in Gift City, I think the combination could be very, very powerful. Because, you know, at the moment, if you go offshore, and Kalpen will hopefully agree with this, we're probably price takers. We're not determining the price. But if you have a strong homegrown business, which is then being utilized into Gift City to attract foreign investors to invest in the same kind of strategies, that's when you can be the kind of you start determining the price, and therefore you can garner better kind of revenues and everything else to help continue to invest in people and innovate on products. And I think that's what I'd like to see in 2025.
Okay, Kalpen, what about you? Everybody's trying to convince you or perhaps make an appeal to you.
Not at all. I think three pillars that I think should get accelerated in the next 3 to 5 years. One is regulation, which make the category more understandable through better transparency, simplified communication, better understanding of fee structures. So investors know really what they are paying, like it has been done in the fund industries. I'm not just for the sake of it drawing parallels, but I believe in spite of all the turbulence in the last 5 years, the fund industry has become more accessible because of a lot of these rules, categorizations, transparency on fees, commission structures, and all of them. So that's one journey. The second journey is I completely endorse what Andrew said, that if in the Gift City, some of the rules are tweaked in a pragmatic way, we really get solid long-term capital, which allows us to invest back in the development of the category of, creating the talent pool. Today, there are many, young managers or analysts who would say, let me go to Singapore or Hong Kong and, work there to manage the same money, which is eventually coming back to India. So why should our talent go out when we can build a big platform here? And I think the third dimension is look for meaningful innovation in terms of, to truly make alternative, very alternative beyond just listed equities, listed debt in traditional templates. So, I just wrote to my team about what Vineet mentioned, that, Avishkar is doing this carbon fund, global and domestic. So let's study. So I think there's a long runway to do meaningful innovation also, and we have to take up that responsibility and deliver that.
Okay, so there has been a meaningful takeaway from you from today's session. It's time for quick rapid fire before we open this up to the larger panel passing questions from you. And I'll start with you, Andrew. Okay, if you were, and you can't dodge any question. Okay, if you were to name the most overrated unicorn according to you in 2021, what would that be?
Listed or unlisted?
Listed or unlisted, any which you think.
Well, I mean, the most overvalued coming to the market was Paytm, so I'm quite comfortable with that one.
Okay, Kalpen, according to you, the most overrated unicorn?
Yeah, I follow Andrew in everything that he does. That's all I can say.
He's just passing the buck. Okay, Vineet, you should give me a different answer. And you are from the VC fraternity, the most overrated unicorn.
I think all unicorns are overrated because valuation and value are two different things. And I never believed in valuation unicorns. Unicorns, if you really want to deliver a unicorn that India needs, you got to deliver an impact unicorn, which touches a billion lives, not really billion valuation.
So you gave no answer.
Yeah, the answer is that unicorn as a concept has no real value, actually.
Okay, Ashish, what about you?
I would just follow Andrew blindly.
what is happening? Like, seriously. Okay, another question to me, another question to all of you, and Kalpen, I'll sort of begin with you. The most meaningful insight or one lesson that you learned during COVID-19, which helped you in running your business, what would that be? One customer insight or something that you escalated back into the product?
I think what really I learned was empathy in that phase of 18 months in context to lives of people or consumers, a combination of both. So at large, at least I've been running businesses with a very rational machine type mindset, and my biggest takeaway was empathy to understand real life challenges and how do you still build people together to come back with energy and give it space. And my biggest takeaway was when I saw my teams also, and I've seen that across industry, more so in our industry, because we were privileged and blessed because of technology that not even one day of disruption in our business lives and not even 1 minute of disruption in our, let's say, ability to earn revenues compared to so many industries which went. So we were very fortunate. So not to take that for granted and convert that into, being more responsible towards our consumers and stakeholders and even our colleagues.
Okay, Andrew, my question to you, a lot of investments is happening into the ESG space. Do you think it's a lot of greenwashing also happening? What is the first thing that comes to your mind, ESG greenwashing?
See, I think there is, and I think that if I look at some of the ESG funds, looking at India, they have some companies in their portfolios which are very questionable. Even the MSCI kind of ESG index has some very questionable companies in their index. So I think it's still a lot to, there's a lot of room for improvement here, and I think it's just I think you really have to do a lot more questioning of companies than just say it's an ESG. I mean, it's a whole. Unfortunately, there's no rules globally which everyone's following, and I think that's part of the problem as well. But one of the problems in India for an ESG fund is if you don't say have one of the largest weighted companies in the index and you've got a large cap portfolio, you're going to underperform. And so, ESG, whilst it's a concept and everyone agrees to it, sustainability and so forth and so on, investors still go back to, are you making money for me or not making money for me? And that's the bottom line.
Okay, Ashish, if I were to come to you, and the highest point in your career, what has that really been, the investing career?
That's a tough one. I think it dates long back, maybe 18, 19 years back, when I did a startup, and it was of course funded by the institution in which I was working in. And over a period of 1 year, I was able to exit that at a 20x valuation to one of the existing companies. It was after the dot-com boom, so everything had suppressed, but yet a 5 crore investment was exited at a 100 crore valuation. I think that was the highest point.
Okay, Vineet, if I were to ask you, what were the most significant 3 minutes, your takeaway from this entire 1 hour conversation we have had, what would that be, besides your meeting with Kalpen?
I think I have always believed in it, that there is always an interesting worldview that you are not privy to. I've been around for 21 years in the investing. I'm a forester by training, so I always thought I am learning all the time. But after 21 years, I heard some terms that I had never heard, so wrapping, etc., etc. But that also tells you that how we look at money and utilization and wealth in very different ways.
Thank you, gentlemen. Thank you for this meaningful discussion. So we have rise of the post-COVID consumer. There's rise of community, somebody who's absolutely money conscious. And I think if I would take down and sort of really compress what we got from this 1 hour conversation, that just don't do innovation in the name of wrapping. I think sort of that was very well said and the point taken home. Second, product innovation has to be truly innovative in nature, and you can't really look at only themes by the virtue of saying that will also make money. Also, understanding of risk and return. Is that communication happening in the way which it ought to be, and how the AIF industry also needs to evolve and perhaps go through its own cycle, which means for the more traditional investment. Aditya, any questions from your audiences which you can take, or do we have more time at all?
I'm sure most of them have questions, Sriza. We are badly out of time right now, but looking at the panel and looking at the enthusiasm of all the attendees here, I'll not like to deprive them of questions. So audience, there's an ask a question button on your screen. Let's give us another 10 minutes to quickly ask 4-5 good questions to the panel. So if you could quickly put up your questions on the tab, I will be happy to take them for you. Okay, so there's a first question for Vinith. And before I ask you that, your line of a unicorn being about impacting a billion lives is going to stay with me for a long, long time. I think it was the line of the day for me. So first question for you, how has the pandemic changed attitude towards social impact investing?
So just to give you an idea, pandemic took the reality about risks to the richest in the world. Because for a very long period of time, it was the poor who were impacted by whatever happened. But in the COVID times, the pandemic actually knocked at the door of the richest, and they just couldn't walk away from it. So I think in a lot of global, and I have a lot of global LPs who started talking a very different tone. Returning money is very important, as Andrew pointed out. They all want the money to come back, but the conscience, the desire to actually play a role has actually been expressed. Does it still mean that we will get more money? The answer is that impact investing itself has become $1 trillion industry worldwide. But 98% of that capital will flow to people who actually have not done impact investing ever, but have been doing investing for long. Because generally money goes to people they know, not to people who know how to do this. So that challenge will remain, but that's the reality that we have to live with.
Sure. There's a question to the panel. I mean, anyone can answer. Indian talent continues to move to Singapore to participate in the hedge fund industry. Are there not enough opportunities in India? Anyone can answer.
I think they are, and I kind of alluded to it previously, is that the tax, unfortunately, is a big hindrance for Cat 3 and for hedge funds. So, if at least the government or the tax authorities just change that, maybe just to a pass-through, I think it would just help the industry grow a lot more. And then, therefore, people would see it as an industry which they could. Not necessarily compete with the mutual funds, because that's not what we're trying to think about, but where you can see size of funds, get to reasonable proportions from where we are today. And I think that's one of the problems. You see these funds with, maybe 2 to 500 crores, and it's just not growing any bigger because the tax part of it. Some of it could be because of returns as well, but it's that tax is just a killer for a lot of high net worth and family offices.
Sure. A question to you, Andrew. Which absolute return funds amongst your competitors do you really look up
to? There's quite I mean, when we first started, obviously there was Edelweiss and DSP, and they remain consciously on our radar. And there has been quite a number of new funds, appear over the last few years. So ICICI have come out with a fund which is doing well. Then there's Zerodo, which came out with a fund which has been talked about quite a lot. So you're always looking at different competition. But of course, I would say, and I'm sure any of those people I've just mentioned, their offering is slightly different than ours. It's a differentiated product even within the hedge fund space, and that's the good news. It's not as though we're all doing the same, kind of ETF type hedge fund. Otherwise, it would be we wouldn't be able to offer differentiated returns either. So those are the people I would say, and I'm sure there's going to be more to come, and I hope there's more to come.
Sure. A question to Ashish. Ashish, equity markets are today reaching out to one and all through apps. What do you think this trend is good? Given the very low levels of financial literacy in India.
It's a tough one. It depends on the cycle. Right now, the way it's happening, my personal opinion is that in the short run, it may be a bit tricky because this deep reach has happened in a period when markets have been really one way, and they've been extremely innovative service providers who've been able to reach and provide access at extremely low cost and world-class customer interface. So the friction has gone away completely, but the underlying risk of the product still remains. So in my view, it will be a good thing in the long run because people will get exposed to capital markets and they will see the alternative ways of making money. But there should be some caution in the short term. They also have to see cycles and they have to understand that, it doesn't move like an FD. It moves like a a graph. The end is good, but there is a tough journey one has to go through. So it can have both consequences, but in the long run, definitely it's good. It gives exposure to the more efficient part of the market.
Sure. Next question to Kalpen and Andrew. Anyone of you can answer. How do you see the global equity markets playing out over the next 1 year?
1 year is like a coin toss. I feel we've already seen, global markets as largely, if you look at mainly, there are three components, US and tech, and then, China. So China has seen large rounds of correction, and US tech has also started correcting in the last 3 months. Other part of US markets have not gone anywhere. So I don't see any major disruption. The only risk is if interest rates rise more than what is priced in the market. But large part of this uncertainty has started playing out in the last 3-4 months as we speak. So I think it'll be, middle of the path, nothing path breaking on either side, if I have to just make a guess. But like I said, it's random and I have no idea in one year what can happen. I can't tell you what will be my own company's, let's say, net profit at the end of the year, or what will be my weight at the end of the next year. So 1 year is very random. And there's a reason why I'm giving such a long answer, that do not expect, the ability to know everything in such short periods of time. I think that is one very big unfair aspiration that we have at times as investors, that we want to know everything in every time horizon. But there are many things which are unknowable, and one of them is this.
Sure. Audience, regret, we'll have to conclude the session here, as we have our next session starting at 4.
Andrew's answer to this.
Andrew, if you would like to take that.
So you want me to answer it, or you have
no, please, Andrew. Maybe some concluding remarks as well.
Yeah. No. So my view is actually very simple. Is that you have a divided market, and you have a divided market about interest rates for two reasons. One, has the Fed too slow, or is it going to be too aggressive? We'll find out in the next few weeks. Whichever happens, valuations have to fall. If he oversteps the mark, valuations will fall. If he just increases rates and it has the impact of slowing down the global economy, earnings are going to fall, valuations are going to fall. So whichever look at it, you're going to have the markets fall.
I must say this, I thoroughly enjoyed this discussion. We had so many interesting ideas coming to the fore. Until the time I see you next, goodbye and good luck. Thank you, everybody.
Thank you.
Thank you all panelists for joining us, and have a great day and a great year ahead. Thank you.
Thank you.
Thank you, Aditya. Thank you all.
Bye.